In this video, we're going to have a look at the company of Lowe's, which is basically like an American home improvement store, quite similar to like extremely similar to Home Depot. It's an American company. I think the European equivalent would be something like the Bauhaus or something along those matters. Something to improve your own home, or buy like a garden set, or buy a piece of wood, or just buy a barbecue, or like all those kind of things basically. Also, apologies if I sound a bit more nasal than maybe I usually would. I am a little bit sick, but I'll try my best to be as coherent and as understandable as possible. So looking here over at Lowe's revenue, we can see a very steady increase in their revenue numbers. 50 billion in 2013, 97 billion in 2022. A compounding annual growth rate of around 7% in their revenue numbers. And this increase in revenue also translates to an increase in EBITDA, earnings before interest, taxes, depreciation and amortization, of about 9% annually, starting with about 5 billion in 2013, ending up at 12 billion here in 2022, where 2021 was definitely a bit of a higher number due to the COVID spike, and all the people were sitting at home being isolated with nothing to do but renovate their homes and improve their gardens. Therefore, of course, Lowe very much capitalizing on this moment in time. And these growth numbers are actually very, very steady and consistent here for Home Depot, but also very much here for Lowe's. They have a debt of about 38 billion, which is a bit on the hefty side now, I do have to say, especially considering they have an EBITDA of about 12 billion. This means their leverage is about as high as they possibly can be. They also always have some excess cash on their balance sheet to really weather any possible storm that might be coming their way. Their market cap, so this is the price on the open market itself, which is basically the share price multiplied by the amount of shares outstanding, has increased by 12.4% annually. This is an amazing return considering that overall the market average is around 7%, and market cap does not even include dividends. So the dividends are on top of the 12.4% appreciation that you could have expected if you bought Lowe's 10 years ago. The enterprise value is the entire value of the business. So it's the moment that we take their market cap, to which we then add the debt and we subtract the cash. Now, coincidentally, their market cap has grown about as fast as their debt level has. So therefore, the enterprise value has also risen by 12.4% annually. EV/EBITDA basically tells us how many years of earnings before interest, taxes, depreciation, amortization, so not the net earnings, but the earnings before any accounting expenses. It takes them on average here 12 years to buy back the entirety of their enterprise value, where we see some lower numbers here in the 10 times ratio and the higher numbers here in the 14 times. Not that much of a spread, so I definitely do think that the moment that Lowe's actually goes towards the 10 or maybe even slightly below it is historically a pretty good time to pick up the stock. Net debt to EBITDA basically tells us how many years of earnings are required to pay back the entirety of that debt level. When it comes to senior debt, they always say about 3 times ratio is where you want to be, because after that you're no longer eligible for senior debt. All the loans that you take on after the 3 times ratio become more expensive when it comes to interest rates, because of course there's a higher likelihood that you will go into bankruptcy the more debt you have on the balance sheet. So this then brings us to their cash flow statement. CFO increasing by 8% annually, about in line with the EBITDA, and so does their capital expenditure. Capital expenditure includes all the things that are required to keep on running the business the way it is. And if you take that cash flow and you subtract the capital expenditure, you get the free cash flow. And the free cash flow is basically your pro rata ownership of the company. This is all the money that's available to you as an equity owner at the end of the fiscal year. And what can you do with this free cash flow? Well, of course, you can just buy back some of the debt that you have, which might be a good idea for Lowe's about this time. You can also pay a dividend, which they definitely do. You can also buy back some stock, and you can do some additional acquisitions or expansions. Now, as we can see in the next column, Lowe has been buying back stock like crazy, absolutely insane. 5% decrease in overall share count annually. Just over 1 billion shares outstanding in 2013 and only 630 million outstanding in 2022. They are buying back shares like crazy. thereby very much boosting your free cash flow per share and also your earnings per share, which is also what we see in the next column, because not only do they increase their cash flow, they also reduce their shares outstanding, which means that the overall free cash flow per share is increasing by 13% annually. $3 in 2013, $11 in 2022. And while I just mentioned that the overall market cap has increased by 12.4% and individual shares actually appreciated by about 18%. Now that is quite a ridiculous number, and it deviates quite a lot from the market cap. And why? Well, because like I mentioned, market cap is the amount of shares outstanding multiplied by their share price. If there are less shares outstanding, obviously the share price has to increase faster than the market cap number. 18% annually compounding annual growth rate here for Lowe's, not including dividends. Amazing return for anyone who bought Lowe's about 10 years ago. Free cash flow yield on average has always been around the 6%. And for the past 2 years, it's been a little bit lower than this at 5%. So let's try to forecast this company into the future. Their earnings has grown by about 9% annually every single year for the past 10 years. Now this number is very much influenced by the insane growth that they saw in 2020-2021. So is it accurate for me to assume that they can keep this up? Well, maybe not entirely. So therefore I'm going to give them 8% growth for the next 5 years and then 6% growth for the last 5 years to be a bit more conservative here with my estimates. I'm also going to attach their average market multiple of 12 times here, and this gives me an enterprise value 10 years from now of $286 billion. From which we then subtract the debt, we add the cash, giving us a market cap of about 250 billion. Divide this by the amount of shares outstanding, and I'm assuming here the amount of shares outstanding remain the same. Given their track record, I very much expect them to actually buy back a lot of shares, but I'm already accounting for that by measuring their free cash flow on top of their increase in share price, and therefore I can't really spend their free cash flow for them because I'll be spending it twice. Therefore I'm remaining this neutral the way it is. And for their free cash flow, I'm going to do a very similar thing. I'm going to grow it by 8% for the first 5 years and 6% for the last 5 years. And do keep in mind here that even though I'm looking at the free cash flow per share, I'm looking at the free cash flow growth here, which has been growing by 8% as put in this column over here. Because the moment that I put in the 13%, once again, I am including their free cash flow because I'm assuming here that they've been reducing their share count, which I can't do if I also take this number into my IRR calculation. I'm going to attach an average yield of about 7%, which is slightly more conservative than their average number has been, but I also think it's okay to put a bit of more conservatism into your forecast. This is giving me a share price 10 years from now, so in 2032, of $302.93. Looking at the stock market right now, I can buy as many shares of Lowe's as I want for $195.75. Taking both my projections, so the enterprise value as well as the free cash flow model, I get an average share price 10 years from now of around $350 a share. This is giving me a compounding annual growth rate on the stock market alone, so simply looking at the price on the open market of about 6% annually, which is about in line with the market consensus of around 7%. But the moment that I include all the free cash flow that I expect Lowe's to be making and returning to you as a shareholder, either in the way of dividends or share buybacks or any other form, I expect an IRR of 14.2%, which is a market-beating return. Overall, the market always returns about 10%. Lowe's is definitely outperforming the market, and especially if they are continually buying back shares the way they have been, I actually expect their share price to be a lot higher than this. And I expect the same for their free cash flow. So let's see what happens if the price goes up or comes down a little bit. So at the moment the price actually drops to about $140 a share, which I definitely don't expect to happen at all. But if it does, I expect an IRR of about 20%. If it drops to 175, 16%. Now the moment that the price moves back up again, because it just recently fell down from a high number of around 200, because the share price just fell down from a high of around $260. If it reaches that number again, I expect an IRR of around 10%, maybe a little bit less, which is about performing in line with the overall market consensus. Overall, I think Lowe's, especially right now, is a very good buy for your portfolio, and if you haven't got any home improvement stores in your diversified portfolio yet, I would definitely have a look at Lowe's. And currently I do prefer them over Home Depot. Thank you very much for watching. Don't forget to like, subscribe and all that good stuff, and I'll see you in the next one. Cheerio!